Hi, Victoria here from the Bookkeeper Hub, HBA and Compass, and the author of Zest for Success. Back in my car studio today, I'm utilising the time while my daughter's at nipper training to have a chat to you about entity structures. Yesterday we spoke about trusts. The day before we spoke about partnerships and sole traders. And today we're going to talk about companies, and then we're going to go a little bit further down the partnership route as well. So a company is an entity which in Australia is incorporated in its own right. It means that it's registered with ASIC, which is the Australian Securities and Investment Commission. It has shareholders who own shares in the company, and it has directors who run that company. Now, that's probably as deep into the nitty-gritty as I'm going to get. So I'm going to talk about the advantages, the disadvantages, and the costs associated with companies. So firstly, from an asset protection point of view, providing the directors haven't given guarantees, all liabilities relating to the company are kept inside the company, which, like a trust, means that your individual assets, your home or whatever it happens to be, are not divvied up if the business should go bad or there was a court case against you, unless, as I said, there is that director's guarantee. So from an asset point of view, a company is a really good structure to have. From a tax point of view, there are advantages in that the corporate tax rate for companies with under $10 million of income is 27.5%. So as long as they're trading entities, which means there is a business involved, 27.5 cents in the dollar is what that profit is taxed at. And it doesn't matter if it's $1 or $10 million, or it won't be $10 million, but $1 million or $5 million, it's still 27 cents in the dollar. And if it's not a trading company or you are over that threshold, it's 30 cents in the dollar. And with that, as with any other company, whether it be BHP or Commonwealth Bank or whatever it is, if you have a private company and you pay dividends to your shareholders, you don't pay tax on that money twice. There is a thing called an imputation credit or a franking credit that comes with the distribution from the company, which means that there's tax that's already been paid on that money and you get a credit for that in your own name. So there's definitely tax advantages to companies and definitely asset protection advantages. On the downside, they do cost money to set up and they do cost money to maintain, and you do need to pay an annual ASIC fee for registration of the company. So financial statements do need to be prepared. That's a statutory rule. So you're going to have accounting fees with a company, which you may not have had with a sole trader. Very similar type cost to a trust as far as running them goes. But you will also have an annual ASIC fee. Now, currently in 2017, it's $249. It does usually go up by $1 or $2 each year as ASIC increases its fees for CPI. And from a rules and regulation point of view, there are minutes that need to be provided if you pay dividends or make decisions or issue shares, and there's an annual solvency minute which you need to sign prior to lodging your ASIC company return. Not a big drama, your accountant can look after that for you, but you just need to know that they do exist. The other downside to companies is when it comes to capital gains tax. So currently there's some amazing exemptions from capital gains tax for individuals, and they flow through from individuals in partnerships and individuals in companies, but they don't, not all of them flow through if you use a company. So the main one that's there is if you sell an asset that you've held for more than 12 months, you automatically get an exemption for 50% of the value of that asset. Well, you don't get that exemption in a company. And the other downside, which is a bit bizarre and hard to explain, but if you use the other capital gains exemptions, whether it be the 15-year rule or the retirement exemption, then whatever profits that are in that company that haven't had tax paid on them, to get them out of the company, it has to come out as a dividend. But because the company hasn't paid tax on that money, you don't get the imputation credit or franking credit that I was talking about before, which means that the owners of the shares in the company end up paying tax on that money. So even though there's a capital gains tax free, it flows through and there is ultimately tax payable on it. So a company is generally not the best vehicle for holding assets that are going to increase in value, such as shares, property or businesses. But as far as asset protection and tax minimisation, just normal income tax, yeah, they're a great vehicle. And if you are in Queensland and you are registered with the QBCC, the company is the best structure for you because they can't wrap their heads around trusts, and it makes the paperwork that's required absolutely horrendous and puts all kind of existing rules in. So that's companies and trusts in a nutshell. I'm going to leave it at that. You can have different varieties of trusts owning shares in companies, or companies being shares in partnerships and stuff like that. And the best advice I can give you is actually have a chat to your accountant before you decide on the best business structure for you, because they will take into account what you're doing, the rest of your family is doing, what other assets you have, the growth aspirations of your business or whatever it is, and sit down with you and come up with a structure that's going to be the best. The only thing that I do suggest is you just try and keep it simple, okay? We've heard of the KISS principle, keep it simple, stupid. Well, entity structures are exactly the same. There's accountants out there who will come and give you a wide variety of structures and all interlinking and all kinds of stuff, but at the end of the day, it may not be the best outcome for you. It may be something that creates great income for them, but not the best outcome for you. But although I say that, if you do change accountants or your structure needs to change, there are exemptions that you can get if you do need to change these. So that's companies and trusts. We're going to look at chapter 4 in the book in our next session. I've had enough for this afternoon. As you can see, the last 2 videos have been me in my car because I've taken the advantage of the time that I've got. And I'll see you on the other side.